There is a pair of Lululemon leggings in somebody's drawer in your house right now. Their own filing says the company made a lot less money on it than they did a year ago. Same leggings, same price. Sales actually went up. The profit fell off a cliff. Last quarter, Lululemon sales grew 4%, but their profit dropped 37%. Two numbers, same 3 months, point in opposite directions. So what's actually eating the money? It's not the product, it's something they buried in the fine print. Once you see it, you can't unsee it. Let's open the filing. Now here's the story everybody was telling. Lululemon is the premium growth machine. The leggings nobody blinks at paying $100 for. The stock that only went up. For years that was true. Then this year the stock fell about 40%. The night these numbers came out, it dropped another 11% in hours. And the founder, Chip Wilson, spent 5 months publicly fighting management. Wall Street called it a brand problem. People stopped thinking it's a cool problem. But open the actual earnings release from June 4th, and one line does most of the damage. Gross margin. That's the money left over after you pay to make the product. It dropped 4.1 points, from 58.3% down to 54.2%. 4 points sounds small, but on $2.5 billion in sales it isn't. And here's the part nobody put in a headline. Most of that drop is one specific thing. We're getting there. Let's start with the top line, because it looks fine. Revenue was $2.47 billion, up 4%. That's the number the press ran with. Now drop one row. Income from operations. That's the profits from actually running the business before taxes. It fell from $438 million to $276 million, down 37%. $162 million of operating profit, gone, on sales that went up. That's the contradiction. A company sold more stuff and kept far less of the money. Think about how strange that is. You'd expect more sales to mean more profit. Here is the reverse. So where did it go? Lululemon was unusually specific on the call, so we don't have to guess. The single biggest piece of that margin drop was tariffs. 280 basis points. In plain terms, tariffs alone ate almost 3 cents of every dollar of product margin. That was the biggest single cause, bigger than anything else they listed. And tariffs raise a question. Lululemon's been around for decades. Why is a tariff suddenly the main thing gutting their margin now? What changed? Here's what changed. For years, a lot of Lululemon's products moved through a customs rule called the minimis exemption. The rule was simple. A package worth under $800 could come into the US with no duty, a free pass at the border. Lululemon ships a large volume of distribution hubs. Much of it crosses through Canada, and a lot of those shipments rode that free pass. In 2025, that rule went away. The free pass closed, and every one of those packages that used to cross the border duty-free now gets taxed. So here's the turn. Everything you've heard about Lululemon, that is lost its cool, that the products got boring, that the brand faded, that's the story on the surface. The thing actually draining the profit isn't on a clothing rack. It's a customs checkpoint. The brand problem is real, but it's the smaller problem. Watch how the company splits in half geographically. The Americas, their home base, revenue down 3%, and same-store sales down 6%. The US down 4%, Canada down 6%. Now China up 30% to $478 million. Same-store sales up 13%. China's now 19% of the whole company, up from 16% a year ago. So the part of the business everyone knows, North America, is shrinking. The part keeping the headline number positive is on the other side of the planet. The 4% growth is China carrying a North America that's going backwards. And none of that fixes the margin. We're still getting to page 1 of the problem. Look at the costs. Selling and admin expenses, the cost of running stores and the company, it's $1.06 billion. That's 42.9% of sales, up from 39.8% a year ago. So spending climbed as a share of sales, while the home market shrank. That's the squeeze working from both ends at once. One more. And it's the one that tends to get worse because it gets better, and that's inventory, and it's up 2% in dollars to $1.7 billion. When unsold product piles up, the usual fix is to mark it down. Markdowns are exactly when margin goes to die. And management said markdowns were part of the drop too. So let's stack it up. A tariff rule closing, home market going backwards, costs rising as a share of sales, inventory that may need discounting. Every one of those pushes the same direction, down on profit. And we still haven't said the part that should worry the shareholder most. Now here's the part the company told you itself, in the guidance, and almost nobody repeated. Lululemon cut its forecast for the full year. They now expect revenue for 2026 to land between $11 and $11.15 billion. Read that carefully. That's a decline of 1% to flat. Lululemon is telling you its sales for the year will be flat or shrink. Sit with that. This is a company whose entire stock price was built on one idea. It grows, premium, and always bigger next year. And management just guided to a year with no growth. And it's not a one-quarter blip. They guided next quarter to revenue down 2 to 3%, with operating margin around 11.6%. A year ago, that same quarter ran above 20. So the squeeze isn't easing. They're telling you it continues. So the thesis is this. The market spent the year debating whether Lululemon is still cool. And that's the wrong debate. The filing shows a company hit by 3 things at once: a tariff change that it can't control, a home market that's actually contracting, and the growth story that its own management just retired. The Leggings are fine, but the math underneath isn't. And the cleanest tell is the guidance itself. The note at the bottom says it doesn't include any potential tariff refunds. That translates to the tariff pain is backed in, and the best case they'll name out loud is that some of it might come back. They're not promising it will. Lululemon didn't lose the Leggings. It lost the free pass at the border, the home market, and the one thing the stock was actually priced on: growth. 2 things to watch. First, North America same-store sales next quarter. If that keeps falling, the "it's a tariff problem" defense gets a lot weaker, because then it's a demand problem too. Second, whether any of those tariff refunds the guidance hinted at actually show up. That's the only line that quietly makes it better. So here's the question for the comments. 2 reads. 1. This is a temporary tariff and inventory squeeze. The brand this strong grows through it. 2. The growth story is over, and the flat year is the new normal for Lululemon. Pick one and say why. If you want the line item walkthrough of every number in this video, the actual filing, exact figures and sources, that's what Footnote brief is. Links in the description and pinned comments, and it's free.